Ed joins us, president at Yardeni Research, of course, one of the most famed market researchers, longtime contact of mine. Ed, great to see you again.
My pleasure.
So I'm looking at your note, and it seems like you're not looking for any more cuts for the rest of the year. We got the one. Should we be done?
I think it is none and done for the rest of the year. As you said, the Fed kind of got ahead of things here. They're ahead of the curve, really, with a 50 basis point cut. With the benefit of hindsight, if they had known what the payroll employment data was going to do, if they had known what the non-manufacturing purchasing managers index was going to do, they would have realized that this economy is doing absolutely fine without rate cuts. And they may have gone for a quarter just as insurance. But 50 is more than the economy needed, and now they don't have to do anything the rest of the year. I think they can take an early vacation.
So let's knock out the kind of first important question then is, does that raise reflation risk, Ed?
I think it does. I think they did get ahead of the curve. So the risk is that they overheat an economy that was relatively hot to start with. But it's a risk. I put it at a 20% probability scenario, kind of a repeat of the 1970s, given what the geopolitical background is. But all in all, I don't think it's a big risk.
Okay. What do you watch to know if the risk increases? How much buffer do we have right now? Do you think the market freaks out if inflation comes in warm? Or do we have a little bit more breathing room at this point?
Right. Well, look, the idea that the Fed may have done more than necessary in an economy that's doing well is actually being confirmed by the bond market. The bond yield, since the Fed cut the Fed funds rate by 50 basis points, the bond yield's gone up from roughly 3.6% to over 4%. So we've had a 40 basis point increase in the 10-year bond yield, confirming my view that the economy is doing just fine and that this does somewhat increase the risk of reflation. The things to watch, of course, are commodity prices. And as you just said, they seem pretty calm here, not seeing a big upward move. We did have some oil prices going up as a result of tensions between Iran and Israel, the mounting concerns that this war is going to continue to spread and increase. But yet there's so much oil out there that the price of oil's down. Price of copper has been edging lower because there's a recognition that China's economy is fundamentally weak. So you put it all together, and commodity prices aren't signaling that inflation's about to be a problem. And the weakness in China, the lack of follow through on their monetary and credit stimulus with fiscal stimulus suggests that they are kind of beside themselves and don't know what to do. And if that's the case, then China remains a source of deflation, not reflation.
And we're looking at a chart of Brent from your report right now. I mean, it looks the trend pretty clearly in place. The role of China and generally, the Middle East is China's consumers, the Middle East is producers, but with the U.S. now being such a big gusher of oil, does that sort of inoculate us to some extent from some of the geopolitical tensions?
I think it does, and that's a refreshing change from the past when every geopolitical crisis in the Middle East caused an economic crisis in the United States. But despite the fact that this administration has said that they're not going to be favoring more drilling, we are drilling 13 million barrels per day, basically matching the previous all-time record high. So there's plenty of oil around coming from the U.S., Canada, and other places. And as you know, both Russia and Saudi Arabia had to cut back their production in order to keep the price of oil from really taking a dive. So again, there's really plenty of oil around. I think even if we started to see Israel take out some facilities in Iran, of course, initially that would lead to a further spike in the price of oil. But the Saudis would undoubtedly be producing more. The Russians would love to produce a lot more. And again, we're producing plenty.
All right. Ed, you break down three possibilities. I love this. This is the way I think about the market as well, as how many scenarios and what probability of each. Roaring 20s. You put that as a 50% probability.
50%,
1990s style melt up, 30%. stagflation 20. And I like that stagflation seems like the only negative one, because that one we've been dabbling with for a while, and we've been able to thread the needle.
Yeah, so 80% subjective probability that it's a bull market, and I think we're still very much in it.
What determines a melt up? Because that part does seem like we've been missing some of those animal spirits. I was kind of arguing that that's maybe better, the tortoise versus the hare. What do you think?
Yeah. Well, I guess personally, I define a melt up as when the market exceeds my forecasts, and I'm known as being fairly bullish on things, and even I haven't been bullish enough. I mean, last year the market shot above my bullish forecast. This year, at the beginning of the year, I thought 5,400, which was really out there as a upside target, and here we are coming on 5,800, which happens to be my latest target. And now what gets me a little bit concerned is everybody's talking about 6,000. It's, the euphoria is starting to kind of crack in. So I would say if we take out 5,800, which we're pretty close to, and start moving to 6,000 and see more people talking about going even higher than that, I think that would be the signs that we're sort of in a melt-up situation. Look, the valuation multiples aren't cheap. Anyway, you slice it or dice it. So I'd like to see the market go up on earnings, and I think the earnings will be there to take the market higher.
What are you expecting, Ed? Walk me through your earnings outlook here. How much does it need to ramp up to fill in those valuations?
Well, things are going according to plan. We haven't really changed our numbers for a long time. We thought, we have not been in the recession camp. We haven't been in that camp for 2.5 years, and that's helped us get the market right. And right now we're looking at $250 a share for the S&P 500 this year, and looks like we're going to nail that pretty closely. And then 275 next year, and 300 the year after that, on the way to 400 earnings per share by the end of the decade. You put a 20 on those kind of numbers, and you get 8,000 on the S&P 500 by year end, and so we're certainly moving in the right direction with regards to earnings.
Wow. So is 6K by the end of the year?
It's possible, sure. I'm not going to, fight this market. I mean, there's a couple of things I've learned over the years. Let the trend be your friend is the simple one for the market. The other one is don't fight the Fed. I think the Fed is being too dovish, but that's what they're being, and that's bullish for the market.
Ed, lastly, what we saw earlier this year was this extremely concentrated rally. The AI stuff seems to have broken up a bit, but then you've got NVIDIA looking like it's warming up for another breakout. What are the possibilities of that hyper-concentrated market in your mind?
Well, we've been arguing that it would broaden out, and we thought that, it could certainly broaden out to the SMID caps, the small and mid cap stocks, which have been such laggards for so long. But their earnings are still challenging. They're kind of in a coma when it comes to earnings. And what got them fired up of late is the Fed lowering interest rates. But if the Fed now decides that maybe there's no rush to lower interest rates anytime soon from here, then I think the market broadens out to the S&P 493. So the Magnificent Seven have done great. They, I think, will continue to do quite well. But I think we are seeing, even today, a broadening out to the rest of the S&P 500. And that's because, and the way I look at it, in the S&P 500, every company is a tech company. They either make technology or they use technology to increase their productivity. And that's the roaring 2020 scenario, that technological innovations will boost productivity, get more growth, less inflation, and that makes for a wonderful market.
All right. Ed, great to have you back. Good to hear your thoughts. Appreciate that very much.
Thank you.
Have a good one. Ed Yardeni, president at Yardeni Research.